Welcome, everybody, to our Trading Index Options webcast. I'm Connie Hill. Happy to be back here with you this week. And I have to tell you, I have your wish list in front of me. I have some of the things that you guys have been requesting over the last, say, 3 or 4 weeks. And we are going to try to knock off a lot of them here today. One of those is how to automate our orders. So we're going to spend a little bit of time doing that. And when we're finished today, I think every one of you should feel comfortable going in and building this little automation that we're going to talk about here. And it'll save you a lot of time. Now, I am joined in the chat by good friend and fellow coach, Barb Armstrong. So glad Barb is here. We'll both be keeping our eye on the chat. She might have to answer some of the things I can't quite get to, but we'll want to know what your questions are. We're happy to answer them. Those of you that are listening to this on the recording, when you have questions, go ahead and put them in the comments section in YouTube. So I go back, I'll review those every day. Make sure you get your questions answered as well. Now, both Barb and I are on X, and we'll post educational content throughout the day, things we notice in the market. Sometimes I'll do a lot with charts. In any case, I'm Connie Hill CS, and Barb is Barb Armstrong CS. Now, I've got several of you that are on the front row here today, which is so awesome. Welcome to Rob Harrison, KB Ojola, Jay Richardson, Michael Austin, Bogus Chinchilla, which I think is such a creative name, Life in the Fast Lane, and many others. Happy that you're all here with me today. Got a pretty full agenda for us, so let's go through our disclosures and get down to the fun business. What we talk about today is intended for educational and informational purposes only. Don't consider a personalized recommendation or advice. Past performance is no guarantee of future results. Dividends are not guaranteed, not especially relevant in this class. Equity in index options, which we deal with here, carry a high level of risk and are not suitable for all investors. We work with European style options, which means that they do not expire early. That's one of the advantages of the ones that we're using in this class, but there are American style index options and they can be assigned at any time. One thing we need to know when trading options at or near expiration, you must consider the risk specific to such strategy, including lack of liquidity, significant price slippage, and volatility, where profits can disappear quickly and turn into losses at or greater than the investment or initial margin requirement with very small movement. This is true also when we're talking about 0 days to options expiration. That's one of the things on the wish list today. Keep in mind, trading those substantially increases your risks due to the limited time frame and the need for monitoring. I'm going to put a word in there, constant monitoring. Probability analysis, when we talk about theoretical probabilities, remember they're not guaranteed, they're just theoretical in nature. We'll use the Paper Money software application. It's a great educational tool. And those of you that are trying to get the hang of these index options, I think trading them in Paper Money is a great way to go until you solidify some rules that you feel comfortable with. Now, one of the things that is on the wish list today is to go through and summarize in a nutshell, the 2 different main systems that we have been trading so far in this class, I'm going to say since I took over. I hope you were here last week or at least caught the recording of Ben Watson's class where he talked about gamma risk specific with 0 DTE options. Very great class that he put on last week. So if some of you are interested in that aspect, I don't want to rehash everything that he did, but it's an excellent resource for you. Now, we'll just take a quick review of index options. We're going to discuss various option strategies. To some degree, we're going to primarily stick with credit spreads. And we're going to be looking at several examples here today, different rule structures, different things that you could consider using. Where can I get a list of the index options? Dennis wants to know. It's a very short list. And I say it's very short because some of them do not have liquidity. All right. The ones that do have the most liquidity would be the SPX options or the XSP options. Also, the Russell 2000 RUT can be on that list. DJX could go on there, but not a lot of liquidity with the Dow options. Okay, NDX could be on there as well. Again, not as much liquidity. So it's just really a fairly small list. There are also some VIX index options that could be on that list as well. So there's not really a spot where we have that list sitting around. But if you just took some quick notes on what I just said, that can produce that short list for you. Okay. Let's see. Yeah, Devin says 0 DTE, smiley face. You're looking forward to that part of our discussion here today. Dejan Viking says, you know, continue the conversation with Gamma and 0 DTE. We will talk a little bit about 0 DTE, but like I said, Ben put on a great class last week about the gamma risk, and we're not going to cover that again today. Okay, feel free to go back and take a look at it. We are going to start out here with the SPX. And you can see on my chart right here, I have, looks like we've got about 6 months on this chart, and I have kind of a basic chart that we have been using. On it, we have a green line, which is a 200-day simple moving average. We have a red line, which is a 50-day moving average, simple. And then this blue line is 20 days. We have been massaging some rules. We've also been using the market forecast, which is down here on the bottom. We could actually take off the MACD because we don't have any rules specific to that, but it can be helpful to just view it. All right, those of you that are not as familiar with what the market forecast is, this one that I'm showing you here is an enhanced one. And an enhanced one gives us coloring in the upper reversal zone, the lower reversal zone. It also gives us some information here about what each line is doing. The red line, the momentum line right now is rising, as is the near-term line, the blue line. And then the intermediate term line, the 86, it says it's falling. And it's true, it is down a little bit, but it's still in the upper reversal zone, which basically says buyers are in control here. And we don't really get negative in that intermediate time frame until the intermediate line comes out of the upper reversal zone, which would be anything lower than a reading of 80. Okay, so basically all three of these lines pointed towards bullishness. You can see here, looks like the S&P is up about 0.32% right now. Was up a little bit higher than that, was actually down a little bit lower. You can see not a huge price movement today. In fact, today's candle right now is what we would call a spinning top, which basically means the opening and closing price, or the opening and current price, are pretty much at the same level with each other. And so not a lot of movement on that here today. Now, one other question was, when we're using this chart, what time frame is the best to look at? Is a 1 day, 1 minute, or a 1 year, 1 day chart? Is that better? Or is a 3-month chart better, was the specific question. And the answer is, depends on how much you want to see, right? For us, what we've been doing is trading some pretty short-term spreads on this one. We'll many times start 14 days out. Okay, we'll get into those specific rules in a minute. So seeing a full year, you might not be able to see the detail quite as much, as opposed to maybe just say going to a 3-month chart where you're seeing immediate future. The signals don't change at all because both of them are daily charts. So I would say whatever is easiest for you to see. Okay. We typically will look at a 3-month chart. If we were working with some longer time frames, say we were doing some trades that we expected to go on longer than a week, you know, if we were looking at a month, 2 months, then we might want to incorporate a little bit more time. But our time frame here is really quite short. All right. Another question comes with our, the next chart that we use a lot for our initial modified strategy here that I have. It's called New Index Options Market Forecast Model. Okay. And the question that came in with this one is, can you use that probability of expiring cone on other things like stocks? And the answer is absolutely. You can use it on anything that you want. Okay. We are looking at it again in a fairly short time frame. We've modified ours to show 30 days. And what do I mean by that? If we come to our probability of expiring cone, come in here to the settings, the period that defaults here is 100. And so it's going to move our timeline. It's going to give us a really big fat cone of which we don't really need to use that much. And so that's why I've adjusted this one to a 30 period, because that's plenty for the time frame that we're using. Okay, we're trading 14 days to options expiration. And then if we're still in the trade by the time our class comes, we get out of it during our class. So really, we're just kind of working with about a week's worth of time. However, you can use that probability of expiring cone on anything. Hopefully that makes sense to you. Oh, how do you get the new version or the enhanced version? I'm going to share with you a grid that has it in it. Okay, this grid, remember, anytime we share any scripts with you, they're never guaranteed as to accuracy or timing. So what I'm sharing with you here, and let me put it also in a text box for those of you that might, oh, that's the wrong, sorry, that is not the right link. Sorry about that. We'll try this one more time. Cancel that. Actually, I'm just going to grab the short formula here. This is what I meant. Not even sure what that YouTube was that I sent out to you in the chat. Sorry about that. There is the right script. And really, you just need these 9 characters. It is cap sensitive. You take those 9 characters, come to your setup, say open shared item, type it in or copy it in, whatever you're doing. Do a preview, then do an import. I'm not going to do an import because I don't want the grid again. Okay, but this grid contains the market forecast enhanced in it. It includes the probability of expiring cone, and then it also includes a linear regression, which this linear regression is set to 6 months. Okay, and I'll review that when I review the rules for each of these. Okay, let's start with our market forecast enhanced model. The rules of this I've got listed here on the side. And basically, we're going to use 14 days to options expiration for the trade that we get into. Okay. We are going to make sure that the price is above the 200, the 50, and the 20 simple moving averages on a daily chart. We're going to make sure the market forecast blue line is up, which it is pointed up right now. If we're looking at that blue line and it is less than 5, meaning, man, it's almost near the bottom, can't go much lower except to 0, many times that might indicate that a bounce is coming forth because it can't go down much more. So if it's below 5, like it was yesterday, yesterday it was at 1.41, we would have said that's just as good as the blue line heading up in a bullish direction. Okay. Do we have those conditions today? Well, here's the price of the SPX. It definitely is above all those moving averages. We just talked about the blue line today is headed up, and we can kind of see it right there as well at 5.24 and rising. And so, yes, it meets those conditions. And so because it meets those conditions, I should also mention, if the blue line is up here in the upper reversal zone and above 80, that's also going to be considered bullish. Buyers are in control. All right. Then what we're going to do is we're going to say, all right, SPX meets our conditions. Let's go out. We're going to place a trade that we've been doing almost every week in this class. Okay. Let's go to the trade tab and let's go to all products. We're going to go to SPX, and then we're going to come down and go 14 days out to options expiration. That gives us the September 2nd options. We're going to go out that far. Oops, that's a little too scrolling. And then what we're going to do is we are going to see if we go 14 days out, where does that fall on the probability of expiring cone? So we're going to take note of the date, September 2nd, come back here to our chart, and now we're going to move over to that second chart that all is on there is some implied volatility, which is just kind of informational. And then we've got this probability of expiring cone. Now, like I said, it goes out 30 days, but we are going to say, okay, let's go out to September 2nd. It's going to be right before the Labor Day holiday on that Wednesday. And I'm going to put my mouse really right on that September 2nd line, and I'm going to see where does it cross on the probability cone that day. Now that looks like, according to the reading on the far right, is 7504. Okay, and I'm just going to kind of draw it in right there. And so what we want to do is because it's bullish, we're going to look to sell a put spread. If it were bearish and met our bearish rules, would be coming up on this side of the cone, and then would we wanting the index to stay below that point. In this case, we're saying, all right, we want it to stay above this point. And so we're going to sell something a little bit lower. So if this is at 7504, we might want to target the next strike available, which is going to be 75. Let's see, this was, let me get back here, 7504, which would be like 7,500. Even 7,500 is where that would be. So we're going to come over to the trade tab. We're going down to these options, and let's find that strike price, 75.00 on the nose. Okay. Do we have some options trading here? Absolutely, we do. Look, this is 14 days out. We've got several hundred and several thousand. Now we are going to sell that 7,500, and then we're going to spread it out by 20 strikes. So that means we'll sell the 7,500, and then the 7,480 is what's going to be our hedge leg. Okay. Now I'm going to put this together, and then I'll show you the old way to put it together. Then I'm going to show you the new way to put it together. That's going to save you time. So the manual way to do this is by just saying sell vertical. And then here's our 7,500, and we're going to go to 7,480 here so that we have a $20 wide spread. And right now, if we did that, credit of about 160 is what we would look to bring into our account right now. Okay. What are our exit rules? Well, our exit rules say if the 50% of our max gain is achieved, we're going to get out. It doesn't matter when. We're not going to hold it for another week when our class gets back together again if it meets that condition. So we're saying basically, hey, we're happy if we get 80 cents out of this and it closes out, gets us out of the trade, and then we're free to enter into a new one. And we would use the probability of expiring cone, would go out 14 days. Suppose it happened to us tomorrow. Then we would go out to what? The September 3 options. Okay, and then we would do the same thing, would see where it lines up on the probability of expiring cone, and whatever the appropriate number is, just get barely outside of the cone is going to be the strike price we would sell. So if we were going to try to automate this, and we just typically are going to do one contract in here for our example trades. Let's see. Shared item isn't working. I think those comments were when I did the YouTube one. Do you need me to share it again? Sorry, that didn't work. Let me share it again. What I'm going to do, I'm going to copy that, and I'm just going to test it out here real quick. Saying it's our grid, and I can see what it mostly is. I'll import it again, even though you typically don't want to do that, just because I want to see what it's going to bring up here for us. And it is bringing up our linear regression chart and our SPX chart with the market forecast. And it's also bringing up our probability of expiring cone. So I do think the link is working. Now I will share it again. Some of you are saying, yeah, it worked for you. Good. Remember, scripts aren't guaranteed as to accuracy or timing, but I pasted it in there. It seemed to work just fine. Okay, let's get out. Okay, if we get 50%, we're going to say we want to get out. So let's build a template. And that template we are going to be able to use over and over and over again. And really, if you are using the same rules and you want to get out on the same rule structure, this is a great way that you can automate it. Okay, so we're going to come in here and we're going to say a first triggers OCO. So we're going to put in two targets. One's going to be a stop. One is going to be, hey, let's collect that 50%. So we're going to do two opposite orders here to buy back this spread under certain conditions. Now I'm going to change this one to a trigger. And basically we're going to say when we get 50% of whatever the credit is, right now it's 170, 160, something like that, get us out of the trade. So I double clicked on that little icon. It started out as a plus minus. Click on it twice, it'll become a percent. And on the percent, what we're going to do here is we're going to put minus 50%. What is that going to say? It's going to say whatever this price was triggered at, we want to get out when the value of it is down 50%. That's when we want to get out. We're going to make this good till canceled. We don't know if or when that might happen. Okay. And it'll put that order in as a limit order. Now this other order here is going to be more of a stop order. Okay. Again, we're going to come and change this to trigger. And we're going to do something different. We're going to say if the value of this spread gets to be 2 times whatever this is. So if it's 160, we're going to say if it's 160, that would be 320. If it turns out to be 170, that's going to be 140 or 280 rather. Okay. If it gets to be 2 times this amount in the opposite direction, we want to get out. Okay. That would mean we no longer have a $1.60 credit, but we actually have a $1.60 credit going against us. Okay. We're going to say we want to get out. And so how we're going to do this, we're going to do the same thing here where we bring it over to a percent. We're going to come over here and say plus 100%. That's how we're going to be able to get out if it goes against us 2 times. Now, theoretically, let's suppose 160 is what we end up with. I'm going to put a lock on it, okay? And let's make this good till canceled. Theoretically, if 160 is our max theoretical gain and we're in a $20 wide spread, what's our max theoretical loss? Well, it's going to be $20 minus a $1.60. which is what? $18.40 is our max theoretical loss. Now, some comments have been made in the past about, man, that is a lot to risk. Why would we do that? And the reason we would do it is with credit spreads, you're typically structuring a high probability trade. If we come out here and look for our, what did we start with? Was it, let me bring this back up. We are selling the 7,500 even. So I'm going to come to that line, 7,500 even. This column is the probability of expiring out of the money. So right now, from the top of the trade, there's a 84% theoretical chance, never guaranteed, that this spread or that option would expire out of the money. Okay. So that's why we would do something like that, and why we would not want to take this kind of a loss. If we can possibly avoid it, we do not want that to happen. Okay. Which is why we're putting in a stop here to say, okay, if it goes against us, 320, 2 times whatever, or 100% of what this is, then we want to be out. All right, we're structuring that. Now, we would be losing more than what we brought in. In fact, would be getting rid of it, the credit altogether, and going negative 160 is what this configuration means here. But that sure is a lot better than taking a massive loss on it. Okay. David said you just tried to copy and paste the on both Play Money and Real. Does not work for me. Must be hitting a different server. Robert reminding us that it is cap sensitive. You have to do the characters exactly, and the very first character is that exclamation point, and that there's 9 characters in that little link. Okay, some of you are getting errors. And I'll tell you, earlier today in one of my other accounts, I had this template set up and had been using it, and it was giving me errors on the using of it. I'm not sure why. I'm not sure if it has something to do with an update, okay, that may have come through that was causing that. However, in my demonstration account that we teach out of, it was working okay. So if you're getting an actual error message, it could be related to something not even having to do with this, with the template. Unfortunately. Okay, but save it. All right. Save it. Now that we have this set up and configured, and I'm going to unlock it here. I just want to see what it's flooding in. If this number changes the credit, these two numbers are going to change dynamically. Okay, we're going to save this as a template, and we're going to give it a unique name. Okay, so I have a couple of these saved already, so I'm just going to call this SPX 20 wide. So I'm giving a real description of what it is. You don't have to use SPX. You could just say, for example, index, and then it's whatever index you're using, SPX or XSP, whatever you might want to be using. So I'm going to say index 20 wide, and I'm going to say plus 100. Oops, let's make that the plus 100 and minus 50 or minus. I did that in the wrong order. Plus, I'm going to go minus 50%. So I'm going to write it the exact way that it's written, plus 100% for our stop loss. And I'm going to put down that it's an OCO. And that's it. Okay, you name it whatever makes sense to you to use. Okay, whatever that happens to be. So I'm going to go ahead and I'm going to hit save. And now we're going to be able to use that over and over. This is your time saver. I'll give you an example of how we go find that again. But for right now, let's go ahead and put our order in. And this one is going to go to our bucket that says index options weekly. Weekly index options. There it is, because we're going to do it every week in our class. Come rain or shine, we're going to do it. And if it exits out of our order prior to us getting back into class again, we'll do another one. Just kind of depends on what my time is like, if I have time to do that or not. All right, we're going to send it off. Mighty says, I forgot how to open shared items. You may have missed when I showed it to you. Does it need to be locked or unlocked? I have it unlocked. And I think I unlocked it before I saved the template. Okay, I got that nice friendly tone that says we were filled on our order. And so here's our 2 OCO orders just sitting out there waiting to get filled. All right, and that's exactly what we would expect. Now I'm going to show you where you can find this, and then we're going to do an example with it. So let me just show you where you're going to find this again. Suppose you're doing another order. Instead of doing 7,500, you are selling, let's say, the 7540. I'm just using that as an example, okay? Right mouse click, say sell custom, and then you're going to come down here. I've got several different custom templates set up here. And so we're going to go look for the one that I just created. And I called it index 20 wide minus 50% plus 100% OCO. Does that sound familiar? That's the name of it. You go ahead and select on it. What does it do? Well, it populates the new credit spread in there. It puts it 50% to say, hey, if we get 50% of it, we're out. If it goes against us 100%, we're out. See how dynamic that is? By custom, pick the template, boom, you're ready to go. And when something meets your conditions and you are ready to fire it off, especially when you might be doing something you want to get in really quickly on, that can just be a real time saver for you. Okay, that's how you find it again. Now, we are also going to do one other trade on our other model. Our other model, and we'll review the rules. Ooh, that's a little messy in there. That's messy because I marked up some stuff. You're just going to have to ignore the writing I have on here because I'm going to need it in just a minute to show you some trades I did today. All right. Our other model, the linear regression model, basically was you're always going to be putting on a bearish trade, or a bullish trade rather, because the long-term trend of SPX is bullish. And the idea is to have frequent entries on this. And so as long as SPX has been fairly bullish, and in our linear regression, which is slanted bullishly, if you're uncertain of using linear regression, I'm going to have you go to our playlist, and maybe Barb can put a copy of that out there for you to go and find. 2 sessions ago, Ben taught last week, and then the week before that, we were analyzing how our linear progression or our linear regression strategy was working, and we went through all those rules more detailed and how we even set these lines up. Okay. The bottom line here is if we're having some bullish signals, say it's bouncing off the bottom line here, the bottom linear regression line, and headed up, great. We're going to take that entry. If it's bouncing off of this linear regression line, which is a 50%, great. If it's bouncing off the middle one, great. We would do all of those in a bullish manner. Now, if the price of the index was up here and was bouncing down and it had a couple of bearish candles, we might consider taking a bearish trade, but would want to see some significant short-term bearishness in the market. Okay. Right now, we are getting a little bit of a bounce here. It's not much. It's a little tiny bit, but it's enough that we're going to do the trade. Now, in this model, we don't use the probability of expiring cone. In this model, we say we're going to sell a 17 or 18 delta. We're still going to go out to the 14 days to options expiration, but we're going to pick different strike prices. Okay, so on here, And I'm just going to delete this because this was just to kind of show you how to grab the template. In this case, we are going to use in 17 or 18. Sometimes it's 19, sometimes it's 16, okay? But we have some decent choices here. We've got 73 open interest contracts on this one. Oops, this is September 3rd. We want September 2nd because it has 14 days to options expiration. This is really the one we want. And okay, where's our 17 to 18? All right, here's a 17 delta. We've got 103 contracts. Here's an 18 delta. We've got 336. That's actually on a 19. And this one's a 17. We are going to pick the one that has the most open interest contracts that we feel comfortable with. We would not pick this one. There's 0 open interest on this 7545. We would avoid it. If you're somebody that does a lot of contracts, you might consider doing the 7550 that has 336 contracts in it. We're just doing one contract, okay? And so we're going to feel comfortable maybe going here, the 7540, and then selling that and then buying the 7520 as our hedge leg. Okay, that's what we're going to do. Now, again, these are different rules. Okay, however, our exit on this is going to be similar. We're going to say, hey, if we get 50% of our credit, get us out of the trade. We had been experimenting having it go against us 3 times our credit. And what we were finding is that was a little more risk than maybe what people were comfortable with. Your situation may be different. And so that's why we changed it so that if it goes 100% against us, then that's when we're going to get out. And that's what we did on the trade that we just set up and the template we just did. Okay, so here we go. We're going to go on this 7540. We're going to do a right mouse click. We're going to go down to sell custom. We're going to come down to where our index option is. And we're still doing 20 wide. We still want the same exit rules. So we're going to pick that template. Okay, sure enough, it queues it up for us. If we get 50% of the 220, meaning $1.10, would be happy campers would get out. And if it goes against us, we've got our stop loss sitting there, we would get out. Now we're going to go ahead and we're going to submit this and we're going to put it in our linear regression because we keep track of that a little bit separately. Something I like to do, I forgot to do it on this. I usually try to put a note in there on the linear regression ones. See if it'll let me add it after the fact. I guess not. All right, we won't worry about it right now. Okay, so we put on 2 trades, both on the SPX. Now, we are going to have to go through a couple of things fairly quickly. We will come back to this topic on Monday. No, not Monday, next Wednesday. It's a hot topic for some of you, which is 0 days to options expiration. All right, trading that. Down here at the bottom in my unallocated section, I did one Russell 2000 credit spread today. We put in the rules. I used that same template, getting out at 50% of the gain. And I just did one trade on it. We netted $65. Okay, let me show you the chart. I think I marked this chart up. And I did a 1-day, 1-minute chart. And I used a different study set. I used something totally different than what we've been using. And let's see if it's not there. Let me add the style here. And this one is called, I am not seeing it here. Let's see. Comparison. All right, it is that one. And moving averages are different. And we're using RSI. And I'm going to kind of zoom in here. On the Russell 2000, oh, this is SPX. Let's go to our Russell 2000. Okay, we are bullish if the index, the Russell, is above the 200-day moving average and above the 20 and the 50. Now, let's make sure. So the blue line here is the 200-day moving average. It's very slow moving. It's not that reactive. 50 is the red color, and kind of this brighter red color is the 20. And so as long as it's above all those moving averages and the RSI line is going up or is above 70, then we're bullish on it. We take a bullish spread trade. And on here, we actually, let's look what was going on right here. And I will say I used some support and resistance in here, okay? We got in here into a bear call spread. So a short call vertical because our RS line was going down and it was below all of those moving averages. And I was working on setting it up just as it came down and crossed here, but it took me a minute to get it all settled and pushed through, okay? I did the same thing. I said, if I get 50% of it, great, get us out. If it doesn't and it goes against us, we only want it to go against us 100% or the same amount we were going to bring in a credit for. This one ended up being here for quite a bit. And then finally, after this big drop, then it hit 50% of our max gain and got us out of the trade. I went back to the timestamps on it and marked it. Okay. Let me show you about some SPX trades. They turned out they were, let's collapse this. Let's open our SPX. We put in 2 put spreads and 1 call spread. So 1 bearish spread and 2 bullish ones. Turns out all of them hit our 50% profit target. It's not always going to happen. We're always going to have some at some point that take a loss. And so we're glad we have that stop loss in place to kind of minimize. But again, we're looking at really short-term charts and we're looking at spreads that were for today, that expire today. Now, many people, this is not for everybody. This is incredibly aggressive, but there have been a lot of you that are curious about it, okay? Let me show you where the trades triggered on the SPX today. I don't think I have the call spread marked, but I do have the earlier spreads on the SPX. And I just did this starting about 2 hours before our class started, is when I started doing some of these trades. So let's come over here. I think this was my first trade. I put a number 1 here. And so at 11:16 my time, which is Mountain Time Zone, if you're on the East Coast, that would be 1:16. The index was above these 2 moving averages. I didn't wait for it to come clear up there. I just said, okay, if it clears those 2, we're good. And we stayed in it until it ran up and it hit our target of 50% of the spread. We said, we are happy enough with 50% of it. It got us out. But then it dropped down here. In fact, it really dropped way down here before I even knew we were out of the trade because I was working on some other stuff. But then it recovered. It came running back up. It was above both of these moving averages again. And then I was kind of noting where support and resistance had been. And it looked to me like it was making a pretty decent bullish candle. So we got in here again. We were above these 2 moving averages. We stayed into this one until actually it executed during our class. Okay, so I haven't marked it on there. Just know that during our class at some point near the beginning-ish, could have been over here sometime, we got out of the trade. Now my time is up, so I can't go into more detail about that. We're going to pick this discussion up when we get back together. Oh, this first one was our call spread. I take that back. Our first one was the call spread. This second one was our bull put spread. And then we had a third one that I put on, and that's the one that got us out during our class time. Okay, real quickly, let me just see if there's anything I can knock out here. I'll post this link. I'll put the link in the description, the link to that template. Okay. For whatever reason, it's not working for you right now. I had my own issue earlier today, so that could have happened to you. Now, one, I hope you're subscribers to our Trader Talks channel. That makes it easy for you to go out, find our content. You can see when Barb's going to post or teach next. You can see when our classes have been. Right? If you're one of our Trader Talks subscribers, you can go over and play the playlist. I mentioned a couple of those classes that you might want to go back to our index options playlist to see those. We would, and Barb just posted it in the chat there as well. We would love to have you follow us. If this was helpful for you today, go ahead and hit the like button on the way out. I did not see any survey today. And I tried to nail most of my wish list that you guys had sent in for me to tackle. So we've had kind of an advanced class here. We've gone at a pretty quick pace. I realize that you may need to go back and listen to the recording again. Now, coming up next is going to be a class more designed to beginners. Okay, Scott Thompson will be teaching getting started with stock investing. He does such a great job. I know lots of you that have been trading for a while still love to go to that class. So we'll have a little break here, start there back at the top of the hour. Barb, thanks for your help here today. Thank you to each one of you for being here today. We'll follow up and continue our discussion next week. Bye-bye.